Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Great to be with you today. As I sit here cutting this video, the equity markets are down anywhere from 5 to 8% here, following along a lot of volatility the last 2 weeks. So I titled today, Order Out of Chaos, Strategies for Your Retirement Savings, despite what's going on with the equity markets and the coronavirus worries. So let's jump right in. First of all, I thought it'd be really relevant to give some perspective. So here on this chart, I have epidemics in the stock market performance going back over the last 40 years, a little bit more than 40 years. We have HIV in the early 80s, pneumonic plague in the 94, there was SARS there in April 2003, the avian flu in 2006, swine flu in 09, Zika virus, Ebola, and then there at the top, you can see the COVID-19 here in December of 2019. Look though, this is what we call a dollar growth chart. The blue line shows the Russell 3000, which is basically like a total stock market US index. $1 40 years ago grew to almost $90 today. So $1 grew to 90, or $1 million grew to $90 million. This gives an example of the compounding effect of equity markets despite anything that's going on, especially when it comes to epidemics. So stay the course. Secondly, I thought it'd be helpful to look at, well, what about prior epidemics and what happened? So what we have here is, again, the chart with HIV, the swine flu, bird flu, Zika, and so on. And it shows that when it was first announced or released that they had this epidemic that we're dealing with, and then what was the return on the equity markets of the S&P 500 6 months later and then 12 months later. Look at this. Almost all of them are positive 6 months or 12 months later after the epidemic is announced or released. And I love looking down there at the bottom. Notice that on average, 6 months later, the equity markets are up almost 9%. And then 12 months later, they're up almost 14%. So even in the midst of great declines due to uncertainty and fear like this, very often we see very strong performance coming back and returns in the equity markets within 6 to 12 months. So what do you need to be doing now? Number one, as I like to say, stay calm and live your life. That's actually not only going to help you personally mitigate the fear, but also by just engaging with society and with the economy, that actually helps. And if we all collectively do that, that'll help our economy move through this. Number two is invest. We've had several clients over the last week or so that if they have cash that they want to invest or they've been sitting with, or they have maybe got a recent bonus, put that money to work now. This is a great time to be buying. We're seeing that the prices are about 18-19% below where they were in the highs just a month ago. Number three is rebalance. So what we mean by that is if you have fixed income or bonds that have gone up in value recently, you might sell some of that to buy into equities while they're on sale. And that's something that we also have been doing for clients. As that fixed income portion of the portfolio grows, we'll buy equities when they're on sale. More on that in just a second. And last but not least is Roth conversions. So what do we mean by that? Well, we know that right now, historically speaking, tax rates have never been lower, at least in the last 40 or 50 years. And with that lower tax rates, this is already a good time to be thinking about taking some of your pre-tax IRA money and converting to Roth, because once you do, the money that's in the Roth grows income tax-free for the remainder of your life. Well, when we do these Roth conversions, we don't sell and then move cash to the Roth and then buy. We'll actually move equity positions from IRA, pre-tax IRA over to Roth. And that right now, those equity positions are really suppressed in value. So you're moving that over to Roth at a very strategic time. So think about those Roth conversions. What I want to close with is, well, David, what if I'm really close to retirement? I'm really scared. I put this together as a perfect example explaining what we call strategic withdrawals. So here in my example, I've got, let's say, $1 million portfolio. It's a 60-40 portfolio, 60% in stocks and 40% in fixed income. So let's say that you retired in January, right before everything kind of hit the fan, and you're like, okay, I started out with a 60-40. Well, here in 2008, as an example, we had roughly a 40% drop. Now, look, we're nowhere near that right now. We're only down 18 or 19. But let's say we had a 40% drop like we did in 2008. Look at how stocks declined from that 600,000 down to 360. However, look at bonds. They actually increased in value by roughly 5%. That's bond aggregate index. That's key because if you have high quality fixed income in your portfolio, and that's what we do for our clients, it's actually it goes up in value when there's a flight to quality or fear. So that actually increased in value from 400 to 420,000. Now look what this sets up. If you're in retirement, you want to take out a 4% withdrawal rate. You're like, I need 40 grand for my portfolio. Look what we do. We use 20,000 of the profits from the bonds and maybe sell another 20,000 of bonds, but you're selling high because the bonds have gone up in value. Fundamental rule of investing, you always want to buy low and sell high. You can do that if you have fixed income in the portfolio. And then last but not least, you can rebalance. So notice in this example, we sell some of the fixed income, buy equities when the prices are really down and very, very cheap, and it sets up the gains coming on the stock market rebound. And look at this too, even after you rebalance and have taken 40,000 out, if you have 209,000 of fixed income or bonds still there, that's 7 years that you can still draw money out from fixed income without ever having to touch your stocks, which gives you lots of time for your stocks to hit bottom and rebound and come back. So one of the things to keep in mind here is if you're getting close to retirement, with these strategic withdrawals, it's hard, if not impossible, to do that with 401ks. If you're taking money out of a 401k, they usually do pro rata. They'll pull out a withdrawal from the same amount from everything in your allocation. And secondly, if you have a target date fund, same thing, it's going to be pro rata. You don't know what they're going to be selling on your behalf. So the way to do these strategic withdrawals is set up IRAs, retirement accounts, outside of like 401ks, so that you can build and structure a portfolio this way to give you the income when you need it. So I'll leave you with this. Fear can have two different ways to think about it. One is forget everything and run, or two would be face everything and rise. What we're doing here at Financial Harvest is facing everything and rising. We're here for you if you're a client or want to talk about getting a second opinion, give us a call. But hang in there. We see lots of opportunity here, and we'll be ready for you when you call.